Third District Finance Committee meeting. May I have a roll call, please?
Good morning. Vice Chair Diana Mayer. Here. And Chair Jed Smith.
Here.
Thank you.
Any comments, public comments on non-agenda matters?
Yes, there are two, Miss Virginia Sodders Mason and Phil Sodder. Go ahead, ma'am.
Good morning, members of the board. I am here to talk about something that you know very well is being added to our drinking water, that's hydrofluorosilicic acid. I would like to give this copies to this is not a benign chemical. This is a toxic waste that comes from the phosphate fertilizer industry. It is dangerous. It costs everyone a lot of money. Okay. It costs a lot in terms of insurance. I'm sure your insurance is increased because it is a toxic chemical that is very, very dangerous for the people who have to work with it. And it also eats away at the chemical, processing where it's held in place and is added to the water. In fact, that was the reason why in 72, I believe, or 71, there was a leak, and the hydrofluorosilicic acid had eaten through the containment vessels and had added extra amounts of the chemical to the water. And some people in West Marin, apparently near the water treatment plant somewhere, was damaged. There are other reports of children being damaged from this chemical that was erroneously added in too high an amount. So it's not a benign chemical. It also is not a pure process. It's not a pharmaceutical grade process. This is a toxic waste that would cost thousands of dollars for those companies who produce it in the scrubbers of their industry to put in a Class 1A landfill. Now, if you're buying this stuff, which you're going to probably do, because you still don't think we need it in our water, and the people of Marin County, we voted twice. I was probably one of those who voted for it, not realizing what it could do to people and the environment. So I want people to really realize that this is an added expense for all of us, not just because of our health, but because of the environment and the damage that it does there. And you don't have to put it, even though there's a state law, supposedly that 10,000 hookups, you are required to consider it. I think that if we look at the vote of the people again, it would no longer be there.
Okay, thank you.
Thank you very much.
Go ahead, Mr. Sodder.
Thank you. I wanted to thank staff and the board members for being here today after another productive board meeting on Tuesday. It's not only your time that benefits the public, but also the quality of the discussion and decisions that are made in these board meetings. This meeting is no exception, and I'm grateful for the detail that's been provided about our financial health. This is our Broom Day in the Valley, so I had to look ahead to the financial update presentation that I'll miss hearing live. And one item that I don't see on the agenda is any mention of our tiered pricing. I recall this being asked for by at least one board member at the last Finance Committee meeting, and I'll hope that watching the recording later will show some discussion around this issue. I think it's important financially for several reasons. First, water revenue is a simple calculation of water volume times water price. So far this year, I understand our water volume is 4% higher than last year, while our water revenues are 4% lower than last year. Clearly, that means we're not selling water at the prices we projected and on which the budget is based. I'm not sure why that is. One likely reason might be that we're not matching our sales by tier projections. And this would be clear if we had information on our water sales by tiers. This information will also be helpful as we plan for district-wide rate discussions later in the year. Obviously, this information will also be useful as we look at meeting our conservation goals. These past few weeks have shown us running about 10% of our water use from last year. And it would be good to know if that's happening across the entire customer base or perhaps in the Tier 4 customer base or elsewhere. I'll definitely look at the meeting recording later, and we'll hope to see a discussion of water sales by tier. And if it's not part of today's discussion, I'll ask that it be included in the next financial committee meeting and/or in one of the upcoming full board meetings. Thank you.
Thank you. There are no further speakers.
Terrific. Well, thank you for the public comments. Although it's practice not to comment on the public comments, I do want to say two things. One, I spent over a decade lobbying DC in the chemical industry, which is one of the least regulated industries in our country, with, I think, somewhere along the lines of 80% of chemicals are not regulated, from tabletops to things that we put in our food. So I will look into this, and thank you for bringing it to our attention. Similar to Phil's comment on tiers, yes, I do think that we should be looking at revenue by tier and how that's working for us. And that does relate to the board meeting on Tuesday. Moving on to regular items. Number 3, minutes for the Finance Committee meeting. Any public comments on the minutes?
There are none.
Great. And I can have a motion, please.
Move
Or
to,
any corrections, or any changes?
no corrections.
Okay.
Move to accept the minutes.
Okay, great. No comments, all good. Moving on to our insurance report, item 3B. Thanks for coming back.
Thanks for having us. Good morning, Director Smith, Chair Smith, and Vice Chair Meyer. My name is Brett Uppendahl. I'm the district's finance director. This morning for this item, we have an update on our annual insurance renewal. And so you may recall from prior years, this is a months-long process that we start in December, work our way through, and we come up with our final renewals in June or early July. So we're getting close to that point where we can be able to actually get the final dollars on our renewals. At this point, we have initial estimates from our insurance brokers here. They're here to present the initial estimates as well as kind of an overview of the market. And so as we're looking at it now, we're looking at overall cost increase of about 11% compared to the prior year. That puts us right about $2 million for our overall insurance annual premium. A lot of this is driven largely by our liability insurance, which is over half of our total insurance portfolio, and that's increasing by between 10 and 15%. So that's really driving the overall cost increase. Property insurance is the next largest item in our insurance or portfolio, and that's about 35% of our overall premium, and that is increasing by less. That's increasing by about 5%. So again, final numbers will be brought back to the committee and the board in late June and or early July, but we did want to give the committee a chance here to hear an update on the overall market, how that relates here to Marin, and what to expect in the coming weeks and months. And so with that, I'll bring up a presentation here, and I'll turn it over to Seth Cole and Alliance, which is our insurance advisors here.
Thank you, Brett, and good morning, everyone. Nice to see you all. Thanks for having us. Again, Seth Cole with Alliant Insurance Services, and with me, Matt McManus with Alliant. Can you guys hear me okay?
Yes.
Okay, good. Sometimes I'm a loud talker, so I get a little worried about the mic. I don't want to blow your eardrums out. So as Brett mentioned, we've prepared a presentation just to give you an update on the state of the property and casualty insurance market and how that relates to public agencies and the district here. We'll talk a little bit about renewal expectations or the renewal estimates. Before we get into the presentation, there is some good news in here. We're in a much better place today in the insurance market than we were a year ago and even 5 years ago. So the market is improved. We still do have some challenges and some headwinds. And so we'll kind of talk a little bit about those and again, how that impacts the district. And then certainly there's a lot of information here. I'm going to go fast. So if you have questions, please interrupt me. That's totally cool. Happy to take questions and make this conversational. That's overview. Don't need to get into that. So just big picture, right? When we're just thinking about the insurance market overall from a global perspective, what are the types of things that are influencing the market and impacting the insurance premiums that we pay? And so we have a number of them listed here. You have, things ranging from social inflation, and we'll talk a little bit more about what that is, mass shootings, cyber attacks, wars, conflicts. They do have an impact on the insurance market. Natural disasters is a significant impact on the insurance market. Inflation and the increased cost of items and construction, supply chain and labor shortage, aging infrastructure. Collectively, these all have an impact on the insurance market. We are in a global economy. We have a global insurance market. And so things that happen in California impact people in other places of the country and other places of the world, and vice versa. Things that happen in other places in the world and other parts of the country do impact us here in California. The market is a little bit regionalized. California, we have our own issues and our own things that we deal with that are separate and different from the Southeast and Midwest and other parts of the world. And we'll talk a little bit about that as we get into the presentation. All right, so there are a couple of financial metrics that we look at to gauge the overall health and performance of the insurance market. And there's a lot of different metrics, but there's three that we really pay close attention to. And one is investment income. Yield on investment and investment income plays a big part in the insurance industry. The insurance industry, just like you, they invest their money and look for returns to help offset losses and pay for different things. As you can see, it's been the last several years, pretty depressed environment for investment income for the insurance industry. 2024, it increased a little bit. 2025, the forecast is brighter with interest rates up, which helps offset losses that the insurance industry pays. And that's why we're in a little bit of a better market condition. So improved investment income is a good thing for the insurance market overall and for everyone, quite frankly. The next thing we look at is policyholder surplus. And essentially what policyholder surplus is, how much money does the insurance industry collectively have in the bank to pay claims, right? As you can see, it's steadily increased over the years. We're not quite at an all-time high in 2024, just shy of the all-time high, but robust, over $1 trillion in assets that the insurance industry has in the bank to be able to pay for claims. So really good for the industry. Part of what's driving this is we've all noticed that our insurance premiums have been considerably higher the past couple of years. So insurance companies have more premium dollars as well as investment income that continues to increase that. A couple of other things why these numbers need to be big. They're very big numbers, and they need to be big for a couple of reasons. One is for regulatory requirements. Insurance companies are regulated by the Department of Insurance for the state in which they are domiciled. And there are certain regulatory requirements that they have certain surplus to premium ratios. So the more premium they have to have more surplus to be able to pay for claims. So they need this to be a big number to meet those. And then also for the rating agencies, AM Best, Standard & Poor's, right? They need to see that the insurance companies are financially sound to assign them financial ratings. So this is a good sign also for the market.
Question. Is the increase in premiums and the corresponding increase in surplus because of all of the things that you documented in your presentation, all of how much more catastrophic loss there is and things like that?
Yeah, absolutely. You hit it absolutely on the head, and I'm going to talk a lot about that in a couple of slides. So thank you for that question. And then probably the most important thing that we look at is what we call the combined ratio for the property and casualty insurance market. And really what this is for every dollar that the insurance company collects in premium, how much they pay out in claims and overhead. So 100% is break even. Anything below 100% is considered a profit. Anything above 100% is considered a loss. They've spent more on claims than they've collected in premium dollars. So as you can see, if we go back 20 years or so, a lot of years in excess of 100%, where the insurance industry lost money. And then those years where you're under 100%, they've made an underwriting profit. I would argue that 99, 98% isn't much of a profit for the insurance industry, right? They're targeting 85%. As you can see, they don't hit that very often, if ever. But the good news is because we're seeing this increase in premiums. And because we have this investment income, we're starting to see the combined ratio level out. So the underwriting industry in the property and casualty industry in 2024, it's the first time that they've made an underwriting profit in many years. And they're forecasted to make an underwriting profit in 2025 as well. We shall see. We started off the year a little bit rough with the LA wildfires, pretty significant, 40 to 60 billion in insured losses. So pretty devastating in our, we still think about all the folks who are impacted by that. Just a horrible situation for the folks who are dealing with that. But this is another good sign. So we have a lot of signs from a financial perspective that the industry is starting to improve. But we're going to talk a little about next some of the headwinds that we're seeing and why certain aspects of the market aren't really improving as we would hope or expect to see. So probably the single largest driver for the insurance industry, whether or not it's profitable or not, is natural catastrophic insured losses. These are hurricanes, winter storms, wildfires, earthquakes get included in this as well. And so the NOAA tracks all of this information, all these natural catastrophic insured losses, how they impact the market, by region. Unfortunately, the current administration cut all the funding to the NOAA. So unfortunately, this information that we find very useful in the insurance industry is going away. So we might not have this as a tool going forward into the future. But as you can see in 2024, a lot of the major natural catastrophic losses that exceeded $1 billion were concentrated in the Midwest and the Southeast. If you go back and look at these charts for the past couple of years, you would see a lot more activity on the West Coast, wildfires, and the winter storms that we had in California. But by and large, California in 2024 had a really good year, which is good for all of us. And we'll get to the even better part when we talk about your property renewal in a little bit. This is just kind of a fascinating slide. We kind of look at when you have billion-dollar events, and these are adjusted for inflation. So in today's dollars, kind of the days between billion-dollar insured events that occur in the United States. If we go back to 1980s, about every 75 days on average, the U.S. would experience $1 billion weather-related disaster. Fast forward to the 2020s and every 18 days. So what this tells us is climate change, changing weather patterns, whatever you want to call it, are having a profound impact on the insurance market. We're seeing bigger storms with much more regularity. This is so something we look at called the bullseye effect that the insurance industry looks at is where are these storms happening? Right? Because we're still seeing a lot of storms, but they're causing a lot more destruction. And why is that? Because we're building and populating areas that are the most prone to natural disasters, right? California, Texas, Florida, right? We're building in areas where you have hurricanes, tornadoes, wildfires, right? And so when these storms happen, there's more values at risk, more lives at risk, and that's impacting the insurance market. This is just a reminder. You see there's quite a bit of red on here. Wildfire is a major concern in California. It used to be a California thing. It is no longer just a California thing. We see wildfires all throughout the country, West Coast, but it's the primary concern for underwriters and insurance carriers is wildfire in California. This shows the distribution of billion-dollar weather-related events in aggregate, the total dollars. Bright red are the states that are most impacted by it. You see California, Texas, Florida. We go back. Where are we seeing all the population growth? Where we're having most of the natural disasters. That's what's driving the dollars associated with these storms. All right, so that's property. Any questions on kind of natural disasters, property would kind of shift gears into the liability side?
Nope.
All right, cool. All right, so when we look at the liability side, and the liability side is where we're seeing more challenges right now. Despite all of the large natural catastrophic losses that we're seeing, the property market's actually in a pretty good place, except if you just recently renewed your homeowner's policy, maybe not so much. Unfortunately, that's the market that's being the most impacted right now. But when we look from the liability perspective, right, someone is injured or something is damaged as a result of your negligence. Could be a water main break, right, that causes a sinkhole or maybe floods out a business house or a home, right? And it causes damage to someone else. So we're seeing a pretty significant increase in the dollars associated with those types of claims. And so first, the frequency. We talked about the frequency, like the numbers of those claims that are happening. We've seen pretty dramatic increase in the frequency of these claims, and for a couple of different reasons. One, third-party litigation funding or financing. I don't know if you're familiar with that or heard much about it, but it's essentially where private investors invest in plaintiffs' law firms to go after lawsuits, and then they get a return, 30% on whatever the final judgment or jury verdict is, right? So there's a lot more people wanting to file claims because they're being backed with third-party financing to do so. So that's a real problem in the industry. Right now, there is no regulations around that. I know at the federal level, they're looking at it, and several states are looking at it as well to try to rein that in. Aging infrastructure across the entire country is a major problem, right? You have a lot of roadways that are in disrepair, aging pipes and different things of that nature. And when they fail, it injures or damages other parties. And we're seeing that with more regularity. And then just dissatisfaction. Unfortunately, I know that's not this room, but a lot of people are very unhappy. We see it on the news and everywhere else, right? And when you're unhappy and something happens to you, someone else has to pay, right? And so that's driving a lot more claims against government agencies, corporations, and the like. The other side of it is the cost of these claims, what we call severity, is what's driving the cost of these claims. One thing is social inflation. It's where we see these much larger jury verdicts, much larger settlement amounts. That's being driven by third-party litigation funding. It's being driven by a lot of different things. The industry is moving away from the terminology of social inflation and really moving more towards legal system abuse that better characterizes what's really happening here. So you'll hear that more often now. Medical cost inflation is going through the roof. When people get injured, it costs a lot more money to treat them and get them better. And then the plaintiff's bar, very well funded. They're having a lot of success with advertising and different things that they're having a lot of success in the courtroom, and that's driving up the cost of claims. And then just inflation. Inflation seems to be in a better place now than it had been the past several years, but inflation does have an impact on insurance and the cost of claims overall because things cost more. So we talked a little bit about social inflation. I'm not going to get into a whole lot of detail, but these are some pretty big numbers. These are 2023 actual numbers. We'll look at a nuclear jury verdict. It's a real thing they call this. A nuclear jury verdict is actually a jury verdict that's in excess of $10 million. And that's actually information that's tracked by the industry. And so the average median nuclear verdict in 2023, and this is across all industries across the entire country, so national figures that they track, almost $24 million. Pretty significant. In California, we oftentimes see these jury verdicts and settlements in the 20, 30, 40, $50 million range, unfortunately. And I don't know if you all saw with Los Angeles County just settled. It's an icky topic. It doesn't impact you guys, thank goodness. But the sexual abuse allegations down there for a whopping $4 billion. County of LA is going to have to come up with $4 billion. They've got a payment plan. It's going to be like 20 years, $300 billion a year or something when you factor in interest. Pretty crazy. So that's impacting all of us just by the mere fact that it costs more money. You could have a simple slip and fall claim or a small water main break, and people are hiring attorneys, and that's driving up the cost of these claims, unfortunately. Third-party litigation funding, financing, not going to get too much into that for the sake of time, but this is an interesting slide. It's a little fuzzy for some reason when I converted to PDF, so I apologize. But it just kind of compares the cost of liability, third-party liability claims, insured losses that insurance companies paid versus the CPI on an aggregate basis back to 2010. So if we go 2010 to 2023, the CPI aggregated is about 40% increase. When we look at liability insurance claims paid by the insurance industry, up 194% over that same period of time. That's why our insurance rates are going up for this reason, unfortunately. And then I just think this is fun. I particularly like the lower right hand the best, but we've all seen these, right? And this really is part of the problem. This is why we are continuing to see an increase in claims. People are ready to hire attorneys when they wouldn't before, and that just drives up the cost of claims, which impacts all of us as buyers of insurance. A lot of this I've already talked about, so I won't get into it for the interest of time. Before we get into kind of talking a little bit about your renewals, any questions on the insurance market and what some of the drivers are?
All
Okay,
good.
cool. So this is just meant here. I think it was included in your packet. That's why I have my glasses on. The print's so small. Is kind of by line of coverage where we expect your renewals to land. These are a little bit conservative, right? We want to build a little conservatism in there until we have the results. But this just kind of shows you in California specific what we're seeing in the insurance market. And this is outside of, you guys have a very different risk profile than a city or a county, right? You don't have police officers, you don't have firefighters, things of that nature. I know you have park rangers, but that's a whole different thing, right? And so for someone like your entity, your agency, these are the types of kind of rate changes we're seeing by line of coverage, right? We're seeing the most difficulties, the most challenges with excess liability, and then, expecting 10 to 15% range. And this is usually the starting point for negotiations. Then you negotiate up, down, depending on your risk characteristics. All of the great, wonderful safety protocols you have in place and all those different things help us tremendously in our negotiations. Just kind of jumping to the actual estimates that we had provided that are included in the agenda packet, Brett had mentioned just nearly about 11% increase is what we had estimated on a conservative basis. Since we put this together, we've had a lot of conversations in the past week with your underwriters. We're very close to have formal proposals from most. And based on feedback that we're receiving in the negotiations that we've been having, we think we're going to be closer to 6 or 7% up. So from these, so drop that a little bit. So 6 to 7% in our mind, pretty good outcome considering what we're seeing in the market. Again, not finalized yet, but we're hopeful to be closer to 6 to 7% overall. A lot of information. I talk fast.
Why, I'm surprised on the property, that there's a negative to a flat rate change. Can you say something about that, especially like with fires and everything else that's going on that could?
Right. It almost seems counterintuitive, right? Absolutely. When we talk about all the natural catastrophes that we're seeing and all of the insured losses that are being paid, you would think that it's counterintuitive. Last year, the property and casualty industry for the first time turned an underwriting profit. And that is in large part because you're paying a lot more for premium than you had been historically. Last year was an average, what we call average anymore, about $132 billion in insured losses for the industry. But because of the investment income that the insurance industry earned, that offset a lot of those losses. And so they were profitable. And because they were profitable and that is attracting more capital into the market, that's offsetting some of the rates. And so we're seeing a slight rate reduction for you specifically. And it really depends on geography, where you're located within the country, and even California. Are you at a high wildfire risk? Marin County, pretty high wildfire risk overall. It does really dictate. So other parts of the country might see a 10% reduction, right? And if you have losses, you might still see a 5, 10, 20% increase. We believe that we're going to see probably -4 to 7 is based on the most recent information we have from underwriters. So, but you're absolutely right. It seems counterintuitive based on everything that I just told you.
Additional capacity as well has entered the market for property. And that's vice versa with liability. Capacity is leaving, right? So when there's more capacity, pricing goes down.
Yeah, more capacity means more competition. When we have more competition, then we're able to drive pricing down. As Matt said, on the liability side, markets are fleeing the state. And so we have less options and less competition. Yeah.
Great. No questions for me. Any public comments?
There are none.
Next.
Good.
Thank you. Appreciate it.
Yeah,
All
absolutely.
good.
Thank you guys
Yep.
very much. Good to see you all.
You too.
Thank you. Very thorough.
I was turned off.
Yep. All right. Moving on to our monthly financial update.
item 3C with Brett.
Alrighty, good morning. This is the regular monthly financial update, and very similar to the last couple months as we're still kind of getting through the slower and kind of more predictable winter months before we have kind of increased usage in the summer. So this rounds out 10 months through the end of April. The fiscal year is 83% of our fiscal year. Again, as we've been mentioning since about November, revenues are tracking very close to budget. We are, within 1% or 2%, as we have been the last few months, of the kind of linear trend. Water revenues there, 81%. I'll break that down in the next slide as usual, kind of ahead of last year's pace. Other revenue, we are a little bit over our initial budget, and a lot of that has to do with interest earnings, as we'll talk about in the next item. But we had a pretty low budget here for interest earnings, and we've been seeing some strong results. So we expect that to continue throughout the end of the year and to end well above budget there. A lot of these items I've talked about in the last few meetings in terms of our budget planning for next year and how those incorporated. So this really just affirms some of those prior trends. On the capital side, I think we've mentioned this a few times, the revenues there are much more fixed as they're primarily coming from our capital maintenance fee revenues. And so those do track even closer to the linear trend, 82% compared to 83%. But all in all, to be within 2 to 3% this time of the year is pretty positive. So happy to see that. Expenses continue again their trend that they've been following the last almost the last year or so now. A little bit of a lag in our personnel services, improving though as we are hiring and kind of refilling many of the vacant positions. So we're a tick above last year, 77% compared to 75% last year. Maintenance or operations, again, a little bit to me surprisingly low. Part of this is driven by a little bit of savings in water purchases as we've been closer to the minimum take throughout the year, as well as some of our construction contracts for paving work. That may tick up a little bit here in the summertime as we get some more jobs going for pipeline repairs. But we were able to make it through the winter without any major issues. And so we should see some savings there. And again, I think I've talked about that in our budget planning for year-end expectations. Financing costs and capital allocation, those are, by design, prorated or accrued monthly. So those are right on track. Total operations are, 70% in terms of operating expense. And so we do expect to have, as I've mentioned a few times, a surplus this year in terms of more revenue than expense on the operating side. And that'll be as we get into the end of the year and into the late summer, as we close out the books, that'll be a discussion to have in terms of reserve planning. And I think we've talked about that also in some of our budget discussions, and we'll talk about it again next week as we do the proposed budget. Capital expenses, a little bit harder to predict as they come in more lumpy, kind of correlating with projects. And as we get construction receipts, we're a little behind budget, actually quite a bit behind, 65% there compared to 83%. What I would say is the construction windows open up dramatically in the summertime. And so we do expect to get quite a few invoices here for progress payments in May, June, and July. And so I think as we close out the spring and the summer here, this should get closer to the 100% mark. Although I would just note here that the budget there for capital expenses includes a pretty large carry forward from the year before. So we're looking at kind of a year and a half's worth of budget here as we have some large projects, as I know Alex talks about in his engineering updates. And so we will probably have to carry some of that budget forward into next year to complete some of the projects on the engineering side of things, as well as kind of start the new projects in the next budget. So this will be kind of an ongoing conversation as we roll forward prior year projects and try to keep the workload going in the most important areas within engineering, and another just getting to kind of full staffing after adding a couple of positions here earlier this year. So we do expect that to ramp up over the summer and into next year. Water sales revenue by month. That's, I think if you kind of look down, bottom line, we're getting pretty close to the end of the fiscal year, so you can kind of start looking at bottom line. So percent of the annual budget, 80%. which is a little bit below where we'd expect. So percent of expected actuals are 96%. That means we're about 4% below where the budget would be. And that is one of those things where, we were setting the budget based on past experience. I think we've talked about this, it's a little bit more of an art than a science. We can't really track month to month which tier everyone lands in. There's a lot of variability, especially in the summertime. So I would generally expect, as we get to May, June, and then into next year's summer, that we'll probably exceed budget here and there because we are looking at kind of the full year in perspective and then chopping that up into, I don't want to say arbitrary months, but based on past history, how we're trying to model that. So the budget may be a little off month by month here, but I do still expect us to end the year really close to where we expected in terms of overall budget. As I'll talk about in a slide here, we're very close on consumption, month to month swings notwithstanding. But I do think that the new tier structure that we do have. We've had some public comments on this issue. This is only our second year in the new tier structure. And so we really only have last year to really compare it to. And last year was a relatively mild year in terms of, a long, wet winter. And so we are still gathering data on this. And this becomes a much more important issue after the end of the fiscal year. I said this a couple times last year as well, but after the end of the fiscal year is when we really look back and take a much harder kind of look at how good we were at budgeting the month to month and how well it aligns with kind of the expectations of the cost of service study that we did. Now looking at 3 years ago. And we don't do this just on our own. As we look into this, kind of the tier by tier and the usage, we will bring on consultants, we'll bring on experts to help us kind of really take a look into this. And we'll make it a priority within our analytical staff as well to try to gain insights into, where were we right, where were we wrong, how has consumption changed over time, how are the rates maybe affecting consumption. So there's a lot of good information there, as I think everyone is expecting. Part of that's financial information that'll come from my staff. Part of that is water efficiency information and customer behavior. So I think that's one of the positive aspects of having our district-wide SAP enterprise, planning, enterprise resource planning system, or basically our software, is that we can bring this data in for billing purposes and financial purposes, and it can be used by anyone in the organization for their purposes as well. So we do have a lot of different eyes looking at this, and then, like I said, we'll bring on consultants over the next coming months and take an even deeper dive into some of this data. And so I don't have the answers for you here today in terms of why the last 2 months are in the 80% range as opposed to where we may expect to see 90 to 100, other than to say I do expect that to even out in the next 2 months. And then I do definitely expect our teams to be looking into this, later in the summer when we have 2 full years of data, and it'll inform our kind of go forward plan. So I am hearing the comments, and I see how this last couple months have been lagging. And so it'll be interesting to take a look at that going forward. Service charges and capital maintenance fees there, the second and the fourth column, those are fixed. Those are, 97 to nearly 100% of the actual budget that we have. The variations there kind of month by month, meter reading and, some of the fees that we do collect are discounted through our discount program. So they're backfilled by our non-rate revenue. So we do expect those to lag, naturally. And then watershed fee, that is a non-tiered rate. So that just tracks consumption essentially, 100 or 1-to-1, I should say. And so we're at 96% there as well. Again, I think that will come back a little bit later in the fiscal year as we see more consumption in the summer. And that's another one that we'll have to make sure we're modeling well to track month by month a little bit better going forward. But all in all, I do feel like these are in a pretty good range. And as they all kind of come together, as I mentioned on the first slide, we're in a pretty good position, especially when you compare it to the expenditure savings that we do have. So I guess from my opinion, to summarize all that, I think we're in a pretty good place. I think it's very predictable. As we talk about the consumption patterns here, we're continuing to see this nice, moderate comeback in terms of overall consumption back towards the average. As we get to the summer months, this will round itself out again, like the tiered rates do. I think we're kind of starting to get a good sense of where maybe our new normal is, or our new kind of average, and it's likely below any of those high points you see on this chart. It's probably I think we may be hitting a ceiling there on that dotted line, that kind of long-term average. That may be the highest that we go with a lot of our kind of more permanent water efficiency strategies in place and kind of more permanent customer behaviors. But the data will tell us that over time. And again, this will be something, not only just tiered rates, but overall volume of consumption will be analyzed more thoroughly in the summer and in the fall. So in summary, our rate revenues through the first 10 months of the fiscal year are 4% below our budget. As I mentioned a few times, operating and capital expenses are both below the budget, even more than that. So we will have an operating surplus and a capital surplus at the end of the year. Our water consumption is about 4% higher than the prior year. That kind of indicates that slow and steady return towards something of a new average, consistent in general with the budgeted amount, as we did expect some level of returning to kind of prior consumption patterns in the overall budget and the last cost study. I would note that in April, we were 3% lower than the prior year. So kind of a point in time, or kind of a snapshot. We were 3% lower in April, and those have tended to kind of bounce back and forth over the last few months in the winter, just as I mentioned at the beginning, as weather dictates, and as we haven't had to turn on our hoses yet, turn on our sprinklers yet. So we will expect that to change in coming months. In the summertime. And then I didn't mention at the beginning, but I try to mention every one of these reports. We are on a 2-month lag here. So we're not really looking at April data. We're looking at February and March data. And so that makes a little bit more sense in terms of tracking to what we all remember the weather patterns to be during that time. With that concludes my report. Happy to take any questions.
Great. Thank you. Any comments, Diana?
No comments. Thank you very much.
Great. And once again, I appreciate your well thought through budgeting. I don't see a full special board meeting for the finance committee for the next few months. I think the next one might be September. So maybe that would be a good time to review this year versus last year, look at the different tiers, revenue impact, and use of water impact, and we could bring it then. So that should be, I think, adequate time if that works for you guys.
That actually works perfectly. Yeah.
Yeah.
I think by the time we get the last 2 months on that lag
Yep.
by August, we should get the full June data in there. And so September, we should have a good chance to kind of dig deep and share it with the board.
Great. Thank you. Any public comments on the financial report?
There are none.
Okay, terrific. So thank you, Brett. We'll move on to our quarterly investment report.
Great. So quarterly investments here. This is my item again. We've spent, I would remind the board, we spent quite a few meetings talking about changes and updates to our investment policy, the last few FAC meetings, as well as in the board meetings. And so I won't spend a lot of time on the details here, other than to say that this is probably the last month that you see the portfolio looking this way, the last quarter, I should say. And we will be making a few changes in the coming weeks to reflect some of those policy directions that the board has approved in terms of diversifying our portfolio and expanding into a couple new areas. But for now, we're continuing to see good news in our investment portfolio. We had our third quarter average was a 4.48% in terms of overall effective yield from our LAIF accounts, which is our primary investment vehicle. That is still better than we were last year. So we're still seeing a higher overall rate of return than we saw last year. Treasuries are the primary component of the LAIF account that we do have. LAIF stands for the Local Agency Investment Fund. Treasuries are about 65% of that overall fund. And so while we have seen a little bit of a dip in terms of overall interest rates and treasuries, they're still much stronger than they've been historically and much stronger than they've been over the last 10 years. And so we are benefiting from that. We do have a healthier fund balance now, as we've talked about in some of our reserve planning. And so that healthy fund balance combined with higher rates is really just sending our investment income much higher than it's been in previous years. So current year to date, we have $2.8 million in overall investment income, well in excess of the budget. And we're expecting that to land somewhere in the mid 3.5 million range or so by the end of the year. And so that's all really good news. It helps really offset some of the lower rate revenues that we've been getting. And it really does help for the next 2 years at least in budget process, as we'll talk about next week, be able to provide a little bit of additional funding and withstand kind of any other revenue shocks. Obviously, interest rates can change, at any time with the Fed's decisions, and so we don't want to rely on that too much ongoing. And so, not to get into budget practicing here, but we are expecting this to come down over time and kind of return back to kind of the more longer term normal rate. But for the time being, like I said, I'm happy to see that our investment incomes is really helping the district in terms of putting our money to work and offsetting any of the fiscal impacts that we have from maybe a little bit lower consumption. And so it keeps our budget in line and just helps make sure we're spending our public's or our customers' funds wisely. So I'm happy to take any questions here. Otherwise, in my perspective, it's all good news.
Great. Diana, any thoughts, comments?
No, thank you.
I appreciated your update with the new budget policies and looking at investment opportunities. You're going to bring that back, as you mentioned,
Well, you'll see the changes updated in the next quarterly report. So we report out quarterly.
Yep.
I
Okay.
think that the policy changes that the board approved over the last couple months allows us just to kind of diversify our portfolio a little bit and
Yep.
invest some of our funds in the JPA funds, which is very similar to LAIF.
Right.
And so we'll report back on kind of our thought process there and within the funds that we're looking to select.
Okay. And that'll be the September one or
It'll be
June,
following the fourth
August.
quarter, so it'll be likely in July or early August.
yeah, I don't think we have a July meeting, right?
No.
Okay. Right.
So we need to get that one in. It may be on a regular board meeting just to make sure we get it in during the timing.
Okay. Thank you. Great. Any public comments on the investment report?
There are none.
Terrific. Cranking. I think I just went through the upcoming meetings, but we have one on June 26th and we have none in July, and in August we have, I saw it, but we have another one in August, and then our full special board meeting in September.
Yep.
Thank you all. We are adjourned.
Thank you.